April 2nd is just days away, and it's shaping up to be a make-or-break moment for stocks. Imagine waking up to a market whipsawing on trade war fears, only to find out a week later that those who stayed calm are celebrating big gains. Here's a shocker. Only 21.6% of individual investors are bullish right now, while 58.1% are bearish, an extreme level of pessimism that usually precedes a rebound. In other words, fear is off the charts, and that could spell opportunity. Today, we're diving into why one top strategist says this could be the buy signal of the year, drawing parallels to the Cuban Missile Crisis, yes, really, and how you can profit big if his prediction comes true. Stay tuned, because in the next 15 minutes we'll reveal what almost everyone else is missing about April 2nd's market setup and how it could blindside those who aren't prepared. The stock market has been on a roller coaster lately. After hitting all-time highs in January, a swift 10% correction hit by early March. The culprit? A 1-2 punch of tariff tantrums and growth scares. April 2nd marks the deadline for a new round of reciprocal tariffs to take effect, essentially a D-Day for the trade dispute. Investors have been on edge. The VIX, Wall Street's fear gauge, spiked, and daily swings have left even seasoned traders feeling sick to their stomachs. In fact, Fundstrat's Tom Lee notes that most investors are getting just nauseous from the volatility, wanting to throw in the towel. But throwing in the towel now might be the wrong move. Market sentiment is often a contrarian indicator. When almost everyone is bearish, who's left to sell? Here's a hint: hardly anyone. That extreme fear can set the stage for a powerful snapback rally. And that tariff deadline? It could either be the spark that continues the chaos or the catalyst that ends it. But why does April 2nd matters? If no deal is reached, the US and its trading partners could impose a slew of new tariffs, raising costs for companies and consumers. It's essentially a self-imposed economic pothole. What one economist calls a tariff is a tax that can drag down growth. On the other hand, if a last-minute agreement or delay happens, it would remove a huge cloud of uncertainty overnight. So, will April 2nd be a trick or treat for investors? To find out, let's look back in time at a crisis that had markets holding their breath, and the surprising way it ended. In 1962, the world faced the Cuban Missile Crisis, a 12-day nuclear standoff. Markets panicked, understandably. But here's the twist. The stock market didn't wait for the crisis to be resolved to start recovering. According to Tom Lee, during that 12-day ordeal, the stock market bottomed 7 days into that crisis and recovered 2/3 of the losses before the resolution. In other words, stocks hit rock bottom while the headlines were still screaming doom and gloom, then began rebounding before any official peace was declared. Why is this relevant now? Because we might be seeing a similar pattern. Lee believes today's market is following that fear-overdone template. The current volatility started when tariff threats began, and we may have already seen the worst of it ahead of April 2nd. If history rhymes, the market could be bottoming before a trade deal is even announced. It's a bold claim, basically saying the smart money is quietly loading up on stocks while everyone else is scared. And it's not just ancient history. Think about more recent panic events. Often, by the time the all clear is sounded, the market has already bounced. This pattern sets up our next part. Could the present sell-off actually turn into a face-ripping rally if the April 2nd deadline passes with good news? Tom Lee thinks yes, and here's why. What if the tariff situation flips from threat to truce? Tom Lee argues we might get a market surprise that almost no one is braced for. In a CNBC interview, Lee suggested that despite all the fear, we could actually have a positive case scenario with these tariffs. Wait, a positive scenario from tariffs? It sounds counterintuitive, but here's his logic. Because investors assumed tariffs would be punitive and recessionary, any deal or compromise would be a huge relief, almost like removing a heavy tax from the economy. That relief could set the stage for a much bigger recovery rally than we expect. Lee envisions a situation where the US and its trade partners strike an agreement, even a partial, face-saving one, by April 2nd or delay the worst of the tariffs. That would be great news for businesses who could then stop worrying about supply chain disruptions and higher costs. Confidence would rush back. In fact, Lee notes that once uncertainty lifts, companies and CEOs may quickly regain confidence to invest and hire again. More on that in a moment. To put it simply, the bullish case is a classic relief rally. Remove the threat, and stocks could snap back hard, potentially hard enough to erase the correction losses and then some. Lee even hints this could kick off a much bigger recovery rally than anyone anticipates. Think major indexes charging toward new highs if the all-clear sounds. He isn't alone in this optimism. Other analysts, like Fundstrat, point out that global markets seem to be betting on a resolution. Look at China, Europe, Canada, Mexico. Their stock markets have been outperforming the US since mid-February. That's a strong hint. As Lee points out, if a full-blown trade war were inevitable, those markets should be tumbling into recession, not rallying. The fact they're up suggests smart money abroad expects a deal, which could make the US market the next to surge once the uncertainty clears. Here are some key bullish signals to watch. Global rally, foreign stock indices climbing while the S&P slumped, a divergence signaling a possible US catch-up rally. Sentiment washout, extremely bearish sentiment, as we have now, often means sellers are exhausted, setting the stage for buyers to step in. Fed on standby. A dovish Federal Reserve adds fuel, with rate cuts possible later in the year. Any good news could hit a market already primed with easy money. But coming up, we'll break down the other side of the coin. What if April 2nd doesn't bring good news? How far could stocks fall, and which investments might hold up in a worst-case scenario? Before we jump into that, a quick mid-video recap and a favor. If you've gained any insight so far, do us a quick favor. Hit that subscribe button and thumbs up. At Market Hive, we're committed to keeping you ahead of the curve with timely analysis and unique angles you won't hear elsewhere. Your support helps us continue delivering in-depth breakdowns just like this. Got a comment or a hunch about April 2nd? Let us know down below. We read everyone. Thank you. Now, back to the action and the bearish scenario we hope won't happen but need to prepare for anyway. Not every expert is optimistic. Famed investor Jeff Gundlach recently warned that the chance of a recession is over 50% in the next few quarters. If April 2nd comes and goes without a trade truce, or worse, with an escalation, the market could resume its slide. Think of it as the volatility continues scenario. The paralysis and fear persist a while longer. What would that look like? First, we'd likely see stocks retest their recent lows and possibly break lower. Another leg down of, say, 5 to 10% could put the S&P 500 near a bear market, minus 20% from the highs, a line no one wants to cross. Sectors directly hit by tariffs would be in the crosshairs. Industrial stocks, think heavy equipment makers and exporters. Technology, especially chip makers and tech firms relying on global supply chains. And automakers could all feel more pain as costs rise and overseas sales falter. Companies like FedEx or Nike, which have already flagged concerns about the global economy, might see further weakness. Meanwhile, investors would likely flock even more to defensive havens. We'd expect treasury bonds to rally, sending yields lower, and perhaps gold prices to perk up as safety trades. Traditional defensive sectors, utilities, consumer staples, and maybe healthcare could outperform the broader market simply by falling less. Volatility instruments, like the VIX or inverse ETFs, might spike briefly as panic selling kicks in. However, even in this scenario, it's not all doom. Why? Because the Federal Reserve is watching closely. Tom Lee points out that the recent sell-off already assumes no Fed help, pricing in roughly a 40% chance of recession with zero intervention. But the Fed has signaled it's willing to step in if things deteriorate. In a no-deal scenario, the Fed could accelerate plans to cut interest rates, effectively putting a cushion under the market. Think back to other times of stress. Think of the 2016 Brexit vote or 2019 trade war flare-up. Central banks often respond with dovish policy that props up stocks. This time would likely be no different. A rate cut or even just a strongly dovish statement in April could soothe investors, limiting the downside. So the bearish case might be more of a slow grind or extended choppiness than an all-out crash. It could be a continuation of the correction, maybe turning into a mild bear market, but not a 2008-style meltdown. Importantly, many strategists, Lee included, do not see the makings of a prolonged bear here, unless the trade war truly spirals out of control for months, which is not the base case. Let's break down potential winners and losers depending on what happens. If tariffs resolved, bullish, industrials, and materials, like ETF, XLI, XLB. Also, companies like heavy machinery, aerospace, and infrastructure could surge as global trade gets a green light again. Tech stocks, ETF, XLK, or semiconductor ETF SMH also stand to gain, especially those with supply chains in Asia. A deal removes a huge overhang. Emerging markets, ETF, EEM, might rally strongly as trade tensions ease, lifting economies worldwide. Even consumer discretionary stocks, ETF, XLY, could jump if tariff costs fade, putting money back in consumers' pockets. How about the losers? Defensive plays might lag. If money rushes back into riskier assets, you could see utilities like XLU, real estate, XLRE, or even gold can cool off as investors rotate out of safety. Also, any stocks that benefited from protectionism, say domestic steel producers that enjoyed tariff protection, could lose a bit of their edge if tariffs are removed. But broadly, a deal is a rising tide that lifts most boats. Now what happens if volatility continues, or how I like to call it, the bearish scenario? Here's who wins. Safe havens shine. High dividend, defensive sectors like utilities and staples become attractive for their stability and yield. Gold and treasury bonds could catch a bid as investors seek shelter. Also, companies with very domestic-focused businesses that don't rely on exports or global supply chains may hold up better than multinationals. Some investors might even consider inverse ETFs or put options as hedges. For example, SH, which shorts the S&P, or VIXY, which rises with volatility, though those are short-term plays for the truly risk-averse. How about the losers? Global trade-dependent sectors get hit hardest. Think manufacturing, semiconductors, autos, airlines, higher fuel costs plus lower travel if economy slows. Retailers that import goods could face margin pressure from tariffs. Also, financials like XLF might struggle if recession fears spike. Lower rates hurt banks' profits, and credit concerns could emerge. Basically, anything economically sensitive would likely see more downside if the trade war drags on. You've probably heard plenty of market pundits sounding alarms recently, from YouTube analysts predicting a crash to headlines about an imminent recession. They're not entirely wrong to be concerned, but here's what many of them miss. The market often moves before the news. By the time a recession is officially confirmed, stocks may have already adjusted. By the time a trade deal is inked, stocks may have already rallied. Tom Lee's perspective encapsulates this. Today's fear might actually be yesterday's news in disguise. Remember, he observed that markets are more paralyzed than pessimistic right now. That paralysis, investors frozen, waiting for clarity, means cash is sitting on the sidelines. Once clarity comes, good or bad, that cash will move. If it's good news, it could flood back into stocks, igniting a rally. Another angle others gloss over: the power of sentiment and confidence. We often separate the market and the economy, but Lee reminds us they're tightly linked these days. The market is the economy, he says, at least in how sentiment translates to CEO decisions. CEOs have been in wait-and-see mode, delaying investments due to trade uncertainty. If a deal happens, that could flip overnight. Companies might unleash new spending, share buybacks, hiring plans that were on hold. That's a tailwind many aren't pricing in. Conversely, if uncertainty persists, that caution could snowball. As Gundlach fears, overseas investors might think twice about the US too. But again, even Gundlach's grim view is somewhat priced in already. US stocks have underperformed global peers, meaning international investors have already shifted money abroad on those fears. If those fears prove overblown, watch for a reverse rotation back into American markets. In short, our unique angle is that this volatility is not just random chaos, it's the market preloading whichever outcome is coming. The key is, which outcome? And that brings us to, what should you do about it? Now that we've explored both scenarios, let's strategize so we can position ourselves for the best possible outcome. So what can you do? This is not financial advice, but thinking like a strategist. You might not want to radically bet on one outcome. Nobody can be 100% sure. Instead, consider a balanced approach. Ensure your portfolio can withstand more volatility, perhaps via some hedges or defensive names, but also position for upside in case of a deal, maybe by keeping exposure to quality stocks that would pop on good news. In practice, that could mean maintaining core holdings in strong companies you believe in long-term, while maybe trimming anything you find too risky or adding a little protection, like cash or gold, as a buffer. This way, you won't have to scramble regardless of what April 2nd brings. Above all, don't let fear take control at the worst time. As Tom Lee put it, markets will bottom before the event actually happens. If he's right, selling in panic now could mean selling at or near the bottom. Conversely, if you're extremely bullish, remember that negotiations can fail, so don't over-leverage on a hunch. Stay nimble and informed. Finally, here's the overnight takeaway as we head into this critical moment. Volatility is a fact of life in markets. April 2nd could bring clarity, one way or the other. Use this night to plan, not panic. Ask yourself, is my portfolio prepared for either scenario? If not, what small tweak could I make for peace of mind? Maybe it's as simple as writing down a plan. If market falls 5%, I'll do X. If it rises 5%, I'll do Y. Having a plan turns fear into strategy. No matter what happens, remember that market turmoil also creates opportunity. Those who kept cool heads in past pullbacks often reaped the rewards when the storm passed. This time will be no different. So, as you sleep on it tonight, consider what the headlines might read tomorrow. Trade truce reached, markets soar. Or tariffs hit, markets turbulent. Prepare yourself mentally and financially so you're not reacting emotionally at 9:30 a.m. when the opening bell rings. Tom Lee's optimistic call might prove true or not, but it's a reminder that in the stock market, the best offense is a good defense, and the best defense is a good offense. In other words, balance and foresight. By expecting the unexpected, you'll be ready for whatever April 2nd delivers. That's all for today's deep dive. April 2nd is around the corner, and it could be a pivotal day for markets. Will it be a relief rally or another slide? We'll know soon enough, and Market Hive will be here to break it down for you either way. If you enjoyed this analysis, please remember to like the video and subscribe for more clear-eyed market insights. Don't miss our next update, where we'll analyze the aftermath of April 2nd and what it means for the rest of April. You'll definitely want to see how reality matched our predictions. Before you go, check out another Market Hive video on how NVIDIA's investments could signal your next big stock investment. Thanks for watching Market Hive.